Focus. Ideate. Innovate. Enable.
Hello and welcome to the Governance Code on CNBC TV 18, a special two-part series that deep dives into corporate governance. In the last episode, we talked about the corporate governance framework in India and the role of the board and promoters. In this episode, we'll focus on protection of the interest of minority shareholders, role of related party transactions, and the advocacy of corporate governance in India. To talk about all of this and more in our Mumbai studios, I'm joined by M. Damodharan, former chairman of the Securities and Exchange Board of India, Ketan Dalal, Managing Partner, Catalyst Advisors, Sriram Subramanian, Managing Director at InGovern, and V.K. Unni, Professor of Public Policy and Management at the Indian Institute of Management, Calcutta. Welcome, gentlemen. Thank you so much for coming on the Corporate Governance Code on CNBC TV 18. Now, corporate governance, Ketan, is, of course, a set of rules and systems and processes that really direct a company. But for our lay viewers, how do you really evaluate governance?
So I think two or three things there. One is, of course, the level of disclosures. And I think a huge amount of prescription on the level of disclosures has been made, whether it is the listing obligations and disclosure requirement or whether in the Companies Act. But in addition to following the regulatory prescriptions, I think the business disclosures, and particularly a lot of this will be clear from, let's say, the management discussions and analysis, and the way that the management engages with external stakeholders. So, for example, on analyst conference calls, etc. So, the disclosure and the engagement and the transparency with which they deal, without, of course, giving it in the public domain confidential information. That's not what we're expecting. I think is an important dimension of governance. And I think investors, external stakeholders are relatively quick now, at least, to pick that up, and that gets reflected in the company's valuations. But I think transparency, disclosures, and external engagement of a very meaningful nature, I think, is possibly an important dimension.
All right. So, Sriram, it's not just an ethical responsibility of the board. There are clear commercial advantages to complying with corporate governance and maybe going much beyond compliance as well. So, tell us, what is the sort of impact that good governance can have on the bottom line of a company, since numbers is what CEOs are mostly interested in?
Good governance also means good business, and adoption of ESG practices means greater sustainability of the companies, because investors are rewarding companies which are transparent, are rewarding companies which are simple, have simple shareholding structures, have simple philosophies, and two is are also focused towards wealth creation, not just for the promoters but for all stakeholders. At the end of the day, society benefits if capital providers, which is not just the shareholders but also the debt holders, push companies to be more transparent or to adopt better corporate governance practices.
So an important aspect of having good governance practices is successfully protecting the interests of minority shareholders. So, Mr. Damodharan, SEBI already has some detailed norms for equitable treatment of minority as well as foreign shareholders. But do you think there needs to be more to that effect? And how do you see the implementation of all of these norms in most of our companies?
See, let me step back a bit. There are only two problems in the area of governance. Everything else is derived from that. One is conflict of interest. The other is asymmetry of information. If you can treat these two imposters with some degree of skill, you would have controlled most of the problems in the company. When you talk in terms of protecting the interests of minority shareholders in the matter of transactions, for example, I don't think you need to prescribe anything additionally in the area of related party transactions. Because if you say that everything has to be approved by the shareholder, business will come to a standstill. Some decisions have to be taken here and now. You can't wait to get to the shareholders and get their approval. On the other hand, the way audit committees are now looking at related party transactions, for a large number of transactions, they spend a few minutes. So clearly, It's just going through the motions of having considered as per the agenda, but not discussing it in any great detail. The management is telling you it is in the ordinary course of business, you believe it's in the ordinary course of business. Management tells you it's at arm's length, you believe it is at arm's length. Both those boxes having been ticked, you think you don't need to go to the shareholders. Right. What I am recommending is that you can't do all the cases. On a test basis, look at the supporting documents on the basis of which you are claiming that a transaction is at arm's length pricing. Don't look at everything. You can't. If there are 1,000 transactions that come to every audit committee meeting, audit committee people will live only in audit committee rooms. Do that also, and this is where shareholder approval is important. Take to the shareholders representative transactions and say that this is the nature of the transaction. We believe it meets both these tests, arm's length, ordinary course of business. We have several such transactions. You tell us whether you're okay with this one transaction. You gain confidence that you have actually bounced it off the shareholder. You don't need to prescribe more. You need to see that the existing requirement of audit committees looking at it closely is carried out. That is what you need.
All right. So, affirmative rights or veto rights, let's talk a little bit about those as well. These are typically granted to minority shareholders, but in a recent battle in a large company's boardroom, we've seen that even the majority shareholders have exercised veto rights. So, what is your view on the provision of affirmative rights? And, I mean, are they really serving their purpose if the majority shareholder can exercise them?
Mridu, it is very difficult to make a general comment on that because it will also depend on the circumstances of the case. So take an example of private equity. So let's say there is a private equity holding, say, 25% of a company, of a listed company. As you know, the takeover threshold is now 25, so it's possible for that. So while they may not have veto rights, they would, I think, be justified in having certain reserved decisions which cannot be taken without their consent. Remember that in this example that I gave, they are also interested in shareholder value enhancement because they are holding 25% in my example. Right. So I'm saying that while veto rights may not always be correct, may not always be justified, there are circumstances in which these reserved decisions kind of thing may be justified. So one has to look at the facts and circumstances of each case. But having veto rights just because you have got a higher percentage of shareholding, you may not even be sitting on the board, you may have, distanced governance from ownership from management, that perhaps may not always be right.
All right. So another perhaps one of the biggest a big menace to corporate governance in India is insider trading, not just India, in other parts of the world as well. So over the years there have been significant norms and significant regulation around it, but what more needs to be done? And from a corporate's perspective, what is the biggest challenge in containing insider trading?
No, as Mr. Damodaran said, it's insider trading has to do with asymmetry of information. As long as there is asymmetry of information between the insiders, so to say, who have access to privileged information and other investors, that is the tenet. So what more can be done? Of course, see, in India we tend to have more regulations and very prescriptive. Enforcement is also the counter to having regulations. Right. In India, unfortunately, enforcement is given a pass-by. And more regulations is thought of as a solution. Have less regulations, greater enforcement, that would solve the problem.
Another point that I wanted to bring up before we close this particular segment of the show, Professor, do you think AGMs of companies need to be much more meaningful, and what are the areas of governance at AGMs that really need to be exercised better?
Yeah, AGMs, of course, have to be much more meaningful, but in that I clearly, I have a very important thing to make, because after the emergence of advisory firms, a lot of the way in which people actually participate and the way in which non-promoter shareholders deliberate, a lot of things have definitely improved. For example, 2-3 years back, I remember one prominent company, when they actually had a resolution with respect to increasing the remuneration for directors, primarily based upon the inputs given by the advisory firms. So it was voted down. They had to come back again with a revised plan with more disclosures and all. Same thing with respect to one of the largest automobile companies. They had to really, of course, by the time the law was also changed, they were able to get the resolution passed. But investors, the shareholders were clearly knowing what is this particular scheme, what this particular transfer of assets or this particular deal is really going to happen, and how this can actually have problems with respect to the particular company which they are actually going to vote on.
Thank you so much. But on that note, we are going to take a short break right now, and on the other side, we'll talk about governing related party transactions and advocacy of good corporate governance in India. You're watching The Governance Code on CNBC TV 18. Welcome back to The Governance Code on CNBC TV 18. On this special show, we are talking about improving corporate governance practices in India, Inc. Before the break, we talked about protecting the interests of minority shareholders. Let's now shift focus to related party transactions. Mr. Damodaran, related party transactions, can they at all be avoided in totality in a company? And secondly, with SEBI's new regulation of getting shareholders' approval for all related party transactions, do you expect transparency to go up?
Answer to your first question, short answer, no. You can't avoid related party transactions. If you avoid related party transactions, a lot of business will come to standstill, because that is the way business has been structured over time.
Right.
But what is it that you're trying to address? You're trying to address a situation in which you believe that some section of shareholders, promoters, because they are on both sides of the transaction, will resort to pricing or even procurement in a manner in which they benefit and other shareholders suffer. Which is why you have the twin tests of, is this in the ordinary course of business? Is it at arm's length? I don't think you need, as I mentioned earlier, to prescribe anything more. But to wish away related party transactions, no. What good companies are doing is, what good boards are doing, is asking managements that if this is the quantum of related party transactions that you're doing, what are you doing to identify competitors to your related party, and seeing that you procure something from them so that over time you reduce your dependence on related parties.
Right.
That's
But won't related parties always be offering the best price?
Not necessarily. In fact, depending on where the shareholding is. If I have 60% in the parent company and 90% in the subsidiary company, which is a supplier, I might give a good price to the subsidiary company, because that's where I'm making money, not here. Not here. On the other hand, if my shareholding there is smaller, I might squeeze that company. Where the protection comes if I can go to somebody else and beat them down.
Ketan, in companies today, what are the current rules and regulations for full disclosure of the ultimate promoter? Because a lot of the times there are several corporate whales and you really don't know who's actually promoting the company. And do these rules also ensure complete transparency and disclosure of all related party transactions?
See, now there are also limitations on the number of levels of holding companies as a result of the Companies Act itself, number one. Number two, commercially, it is also no longer making sense, partly because of compliance cost, partly because of dividend distribution cost, and partly because promoters themselves do not want complicated structures with it themselves, then later find it difficult to unravel. And I've seen situations where the family becomes larger, and then it even becomes difficult to know who has what beneficial interest. Right. So I think there are automatic checks and balances to which this is happening. So I think one shouldn't again over-prescribe. You have disclosure norms, you have in the listing agreement, you have in the Companies Act. I don't think we should over-prescribe any of this, because I think this prescriptive thing has really gone quite far. And I think we just need to just pause for some time and let market dynamics and other checks and balances take over, at least insofar as many things are concerned, and particularly in respect of the disclosure that you talked about.
All right. How can you strengthen awareness as far as shareholders' rights are concerned? And secondly, who's best enabled to really lead this whole activity?
No, I think every stakeholder has a responsibility to strengthen awareness. be it directors and the company itself has to do its role of conveying, as Mr. Damodaran said, at AGMs or through the other material as to what the rights of the shareholders are. So if you see Warren Buffett's letters and Berkshire Hathaway's annual reports have much more details of what the shareholders' rights are. And so I think that is the responsibility of the company. Two is the responsibility of the large institutional shareholders. Institutional shareholders today, of course, are in the asset gathering, sort of going and publishing ads, etc., from an asset gathering perspective. They also have a responsibility to educate investors on their rights, and that is something one would like to see.
But the Companies Act 2013 is largely governed and driven by a Western governance model. So I'd like your views on, how geared up is it in the Indian context? Are there specific areas as far as corporate governance is concerned that really you think need customization to the Indian market?
No, the Companies Act 2013 may not be purely based on a Western model, because the J.J. Rani committee report which came, we finally did not adopt that. So it was that later on there was a Yashwant Sinha committee report which brought in a lot of changes, primarily because
the roots
of the
that
Satyam
began
scam
were...
and all. Of course, the corporate governance norms, which is actually the listing agreement, or clause 49, is primarily based on the Sarbanes-Oxley Act as well as the Cadbury committee recommendations. That's what I was saying. So they were actually relying upon an outsider model of corporate governance, which was actually their primary concern, because all those companies were having very large dispersed shareholdings, where the concept of a very dominant promoter was not there, or a very dominant controlling stakeholder was not there. Our things are not like that. So here, of course, the promoter shareholdings are coming down, but still promoter is a very, very dominant party here.
Mr. Damodaran, let's talk a little bit about taking corporate governance to the next level in India.
Let's look at the largest majority shareholder in India. No prizes for guessing, the Government of India. Banks are listed entities. Bank boards read from the newspapers that the managing director has been changed. At least have the courtesy of informing them beforehand and making it look like the decision, even if you take it, so that the outside world sees the board as empowered. No. You have exemptions. I was going through a list the other day of banks which don't have to comply with certain provisions of the Companies Act or the listing agreement, even though they happen to be listed entities. And I know that SEBI is pushing to get more compliance. Right. They don't need to have a nomination and remuneration committee. Why? Because it's been exempted. Now, you can't have the largest shareholder functioning on the strength of extensions, exemptions, etc. Women directors. Who are the people who don't have women directors on the board? Who are the people who for a long time didn't have the prescribed number of independent directors? Set an example. Let government lead by example, and then you will see people fall in place. Today, people are not asking questions, but the questions exist. If government companies are not doing this, why do I need to do this? It's unfortunate. You need to do it because there is value in doing it. Yeah. That's a different matter. Yeah. But still, the fact that there is an example of another kind somewhere is a kind of a dampener for governance.
Your solutions for taking corporate governance to the next level in India?
I think market dynamics will itself take its role, particularly because, Mridu, we already have a very large number of prescriptive regulations. Right. I think the time has come to pause, in fact, simplify them, and I think market dynamics will automatically take. But I think one thing is the important thing, and I think one of the panelists did mention that, the importance of getting good quality people. Now, whether it is in terms of the nomination and remuneration committee getting the right people as key management personnel, or whether it is getting non-executive directors, I think the heart of the matter is to get good people, and some part of the problems that we are facing today will get solved. Some of it is already getting solved, so we shouldn't pretend that things have not improved. Things have improved, but I think long way to go, and maybe these are some of the thoughts that could help.
Okay, so let the government lead by example, regulate lesser. Your solution?
I think obviously, those are parts of the aspects of governance. One of the things one would like to see is, of course, the second largest shareholder or the largest institutional shareholder also to exercise its might. No prizes for guessing that it's LIC also. It also needs to act as a responsible investor. And two is companies, of course, are increasingly realizing that good governance shareholders are rewarding companies with good governance practices. So I think that sort of helps.
All right. Professor Unni?
Yeah, anyway, I also agree with the panel that laws and regulations we have in large numbers. Yeah. So it's essentially a question of trying to implement them.
Thank you so much, gentlemen. It's been a pleasure talking to you. Thanks for joining us. With that, it's a wrap on this special two-part series on corporate governance. Hope you enjoyed the information and insights. Thanks for joining us. Goodbye.
Focus. Ideate. Innovate. Enable.